No. Yep. Oh, okay, better. Okay, good morning, everyone. Thank you, Vittoria. Thank you so much. You let us open the EBC today. Let me introduce the panelists. We have Serra. She is the founder of Aegis Trust, one of the 6 qualified custodians in the US, and also the only one with a digital custodian license in Asia. Welcome. And we have also Clarisse, who is the co-founder of the funds. So welcome, ladies. And let me start. So lately, we hear a lot the phrase, your keys, your crypto. Digital assets have been withdrawn from many centralized crypto exchanges because of not your keys, not your crypto, obviously. At the same time, we have an uptick in online searches for self-custody and cold storage. So my question is, do you think we are heading into a world of your keys, your crypto, my keys, my crypto? And what does this mean for Web3 and the crypto world in terms of mass adoption? Clarisse, do you want to start?
Sure, I can start. So we're not going to dance, right? Everyone knows that. Yes, so absolutely 100% aligned with the sentence, with the principles, not your keys, not your crypto. To me, we all started using decentralized custody because we wanted to remove the need for trusted parties in the first place. So it's not a matter of if, it's a matter of how, in my opinion. When Andrea Ankonopoulos says, your keys, your Bitcoin, not your keys, not your Bitcoin, he actually means physical ownership of the private keys, having your private key in your pocket, right? So if we take 2 seconds about, thinking about the concept of ownership, right? In real life, you do own assets that do not fit in your pockets. For instance, you have a car, right? You own your car. If someone stole your car, you get to local authorities and you can claim your car back. It's your property. So it's been built over centuries of social contracts. And so that's how ownership has evolved. So I believe blockchain should be a way forward. Technology should bring us to an understanding of ownership that is a way forward, not backward, not a sort of a tribal way of understanding this is yours, you need to own it and actually have it physically in your pocket, right? So the reason why, for instance, at Defense, we still think your keys, your crypto, but not actually physical ownership. We believe in signing power, and the reason why is because people have lost billions of dollars because they tried to manage their private key themselves, right? Even the most sophisticated developers, so I think earlier this year, a guy named Luke Dasher is actually a core Bitcoin developer. He actually got his keys compromised. So it's because key management is hard. It is hard, right? It does take a lot to actually know how to secure your keys, your keys, sorry. So today, for instance, when people say and keep on saying, it should be self-custodial, you should do it yourself. What people do actually when they buy a hardware device, the first thing they do is they back up their seed phrase in plain text on iCloud, making it more vulnerable and making it a bit useless, to be honest, to actually buy a hardware to actually start with. So there is technology, there is for instance, we use multi-party computation. MPC is a great way to actually remove the single point of failure and enable you to actually keep on going, keep on having that ownership of your crypto. Why? Because we can provide a recoverable cryptographical proof that the user actually signed a transaction. And so as we are going and trying to reach mass adoption, we believe that we won't achieve mass adoption by all carrying a private key in your pocket. So to conclude on that point, I believe we need to go this way, right? The question is how we do it. And for instance, envisioning decentralized custody, which means that what matters is not only where your private key is, ownership doesn't matter, but how you access it, making your identity the recoverable proof of your signing power, I think this is the way forward, and this is how we are going to create a UX, because it's super important. There's no security that is viable, sustainable if UX sucks. So a UX that enables people to actually be comfortable and sign transaction and stay in ownership of their cryptos.
Thank you. What about you, Serra? Do you think that we are heading into a world of your keys, your crypto, my keys, my crypto? And how does that impact customer behavior? Are we shifting into decentralized exchanges?
Yeah, so it's really interesting because yesterday SEC put out a proposal essentially requiring asset managers, like so-called institutional investors, to actually put the customers' funds. Do you want to try this one? Okay. Yeah, okay, so it's much better. Yeah, it's like really busy last night, and we were talking this morning because SEC put out a proposal basically requiring asset managers, institutions, investors to put their customers' funds in qualified custodians. And to that said, what Clarisse was said, it doesn't really impose additional restriction on individual investors. So individual crypto asset holders can still own their cryptocurrencies and store on whatever devices. But for institutional investors now, it becomes actually more clear and with the regulations that they will actually have to use qualified custodians. And specifically, SEC also said the business model for crypto exchanges does not meet qualified custodians. So they're pushing further regulation for investment funds, essentially not being able to trade freely on lending platforms, exchanges, given a lot of the incidents that happened recently. So what that really means that as a custodian, which is very interesting about private keys, like especially in the US standard, we were required to demonstrate to our regulators that custodians actually own private keys of our customers' funds. We're also required to demonstrate that all customers' funds are in segregated wallets, right, or on-chain wallets for customers. And on top of that, all the other additional requirements by insurance, like we're insured by Lloyd's of London, we have to prove to our underwriters that we hold private keys and customers' funds are also segregated. So I think there's a lot of shift in the industries for institutional investors, but obviously I think for crypto holders like we are, I think there's like more flexibility to do that.
Thank you, Serra. I still think that centralized exchanges have still a future, and not because they have a better UI, UX compared to the decentralized ones, but I think the key here is to get rid of bad actors. And why not shift to smaller exchanges like BITMarkets that they don't have a hidden agenda? Speaking of bad actors, FTX. FTX was a wrecking ball in 2022. Some even claim that FTX triggered the collapse of the stablecoin USD in May. In any case, the fallout was really bad. It was immense. What is your opinion, apart from the criminal investigation and who is guilty of what? What is your opinion about the situation with FTX, and what does this mean for the Web3 and the crypto space moving forward? Serra?
Yeah, so I think it's related to my prior comments on how investors are getting more concerned because FTX really kind of inflicted a severe concern of the safety of the assets in crypto exchanges. And I think the regulators also came out and said, you know, if you put your assets in crypto exchanges, I'm so afraid there's so many crypto exchanges.
I would say it depends on the crypto exchange. Okay.
Essentially, if you go down to the bankruptcy route, then the investors are putting in line in the bankruptcy court. So it's harder for investors or customers to retrieve funds. in the bankruptcy, because it's hard. You cannot. It's like the way crypto exchanges currently do business. It's harder to prove the assets are segregated. So I think FTS really kind of spurred that change in the industry. And then I think it also pushed regulators to take more tightened stance in this industry.
I think centralized exchanges were born because it's hard to actually interact with blockchain, and that's pretty much why centralized exchanges really, got developed over the past decade. I think there's technological answer to rebuild this trust, right? I agree with you. Doesn't mean that centralized exchanges need to disappear.
Thank you.
And
I'm still on business.
But the first point is actually segregation of funds. I think this is very, very important. So developing segregated wallet infrastructure is the only way to guarantee that if you go bankrupt, your users' money are not at risk, right? And it goes by knowing what technology you use. So I'm going to be a bit technical on you at so early in the morning. That's our background at Defense. So basically, for instance, most of exchanges operate on what we call omnibus infrastructure. Problem is that omnibus infrastructure is that you pool users' money. We advise at Defense to operate with segregated wallet infrastructure, but be careful. A lot of time people will tell you, hey, you have an addresses. If you have an addresses, doesn't mean you have a private public key attached to these addresses. Most of the technological service provider out there will use a technology that we call HD wallets that enables you to actually derive addresses from one single private public key pair. What it means concretely is that if you hack one private key, then all your users' money are hacked. So demanding as a user that your exchange wallets use segregated wallets is super important. That's the first point. Second point is the accountability of offline signing. So when you actually sign a transaction on Binance, on Coinbase, who tells you that the actually transaction you've entered is the one that went on chain? There's no accountability between the moment you press your transaction and the moment that the transaction is on chain. So we are also working to make sure that technology like MPC as ours accountable as multisig, that the metadata of the transaction that started from one point till it goes on chain is actually verifiable in a privacy-preserving way. This is super important. Technology can solve this issue. With this type of solution, we would have seen a lot of things that went wrong in the management of FTX. The third point is either you choose to comply and being actually, regulatory clean, compliant, so be transparent, make sure that, for instance, you start also, you're proactive because regulation is catching up, so you demonstrate, for instance, proof of reserves, things like that. Or if you don't comply, then you leave the power of signing, you leave your user in charge of their private key, meaning you are a non-custodial exchange, which is something that you can also achieve. So there's different ways. I think technology is here to serve exchanges to actually rebuild this trust and to make sure that they operate in a trustworthy way.
Thank you so much, both. They say that 1 week is a long time in crypto, and indeed, what happened last week is an example of that, with the SEC declaring that staking is violating the securities law and BUSD is an unregistered security. How do you think this will impact the digital asset space, and what does this mean for US in terms of its leadership position in financial markets and technology?
So for Aegis, we build our own technology, MPC-based, specifically for on-chain transactions, including staking, liquid staking, and DeFi. So we support one of the first, the first to support like liquid staking a lot. So I think when the news came out, it was really a surprise to a lot of the industry players, including us. But it also highlight the differentiation of how technology infrastructure company normally does on-chain transactions. So essentially providing the user interface and allowing the customers within the custody to directly interact with staking node providers or staking validators instead of crypto exchanges where they pool customers' funds together and create different type of yield earned products that being defined as securities in the US by SEC. So I think what the industry is really leading to is, I think it's going back to the fundamentals of blockchain technology is the transparency, the on-chain activity, on-chain wallet, and direct interaction versus, adding on whether that's a lending platform or crypto exchanges where you essentially having pooled the rewards for stakings together and essentially creating more like an investment products to retail investors or investors. So I think after the incident, a lot of the industry's players, us, come out and really kind of educate the market and the community in terms of what is actually a better way to do and leveraging the technology which we were supposed to do more instead of doing more trading, creating more programs that attract people into the industry, but essentially didn't have the risk management as well as the infrastructure built to sustain and really kind of create like a better solutions for this industry as well as for overall financial system. So I think it's starting to see companies that are really taking a lot more practice as well as efforts into differentiating themselves for providing the institutional type of infrastructure solutions really kind of stand out. And it also require more compliance and more programs internally or externally by the auditors to kind of differentiate how everyone does things. So I think the short-term impact is obviously big because a lot of the people are still trying to comprehend the new regulation changes. But I think in the mid-run, it will really kind of set a new standard for this industry to really be sustainable and then grow.
Yeah, I'm quite aligned here. It's true that we see that the institutional US market is a bit paralyzed these days. I mean, they need stable regulatory environment to operate, and recent successive announcements are a bit difficult to manage, right? Where is the final regulation going? Where is the SEC going? What does it mean for institutional players? How they're going to position themselves? At the end of the day, it's a bit normal, right? When you are putting yourself once again as a trusted party, it's normal that you complied with regulation, and regulation is adjusting to the recent events. I think the good news is that we see DeFi quite, reborn by this uncertainty environment, right? At Defense, we see more and more actually decentralized application coming to us saying, I don't want to touch my user funds. I just want to build the bridges, build a product that enable my users to directly interact with other users so they can actually, exchange, trade, swap, etc., etc. So we see a lot of innovation on this front, and this is why I'm not too worried about the United States, because even though regulation is being a bit difficult these days, they have quite a bit of resources to innovate, and we see a lot of activity on the DeFi side.
Thank you so much. I'm aligned with both of you. I would say as a conclusion that we don't need more punishments. We need regulations that are tailored to the crypto space, and we need regulations that they don't hinder innovation. Thank you.